Hey, Blockhead Traders. Here at Blockhead Traders, I must inform you that we are not financial professionals. Nothing we say should be considered financial advice. We offer our own thoughts and opinions to you, the viewer. We expect you to take these opinions and form your own financial opinions and make your own financial decisions. Today is Wednesday, July 13th, 2022, and this is Blockhead Traders Weekly. In this week's episode, I am joined by fellow Blockhead trader Viper XL007, and we are going to take a slight deviation from some of our normal banter about stock plays and crypto and things like that. And we are going to touch on the topic of inflation, recession, and the state of the U.S. market these days. But before we hop to that content, I want to give a shout out to our Discord, link in the description below. You can hop in there for free, say hello to myself, Viper, a few of the other Blockhead traders. Love to hear what you're trading, love to hear what you'd want to see on the show, and we will make that content for you. But let's hop to this week's content about inflation, interest rates, and recession. Viper, I kind of took a pause recently from the markets, from trading, and from just paying attention to news. I went on vacation with the family. It was a great time. I peeked at my portfolio here and there, but I really didn't follow closely the tickers every day. The news. A lot of my plays are kind of in what I would call cruise control, where I'm confident in them. My thesis is not really getting undermined, and I enjoyed some time off and came back this week to an action-packed week here. The U.S. CPI numbers, or consumer price index numbers, came out actually today. We have the very next round of earnings reports, starting with financials tomorrow. So all this stuff, by the time this video is released, will have already happened. And I thought we could just take a little bit of the show today and talk about our views on the state of the U.S. market. If you flick on the TV, everybody says, oh my gosh, it's doom and gloom, run for the hills. The market's crashing. And I feel like, guys, where have you been? This has been all of 2022 so far. And so I thought we just give a little bit of our thoughts on that point. You've heard my thoughts here and there if you've kind of watched a lot of the episodes that we've put out there in 2022. Inflation is absolutely high. I mean, I feel it just going to the store and looking at the price of meat, looking at the price of bread, and just going to a fast food place. I mean, I told you we recently went on vacation, and we stop at Wendy's, McDonald's, whatever, and these meals, which maybe a year ago I swear I was getting for $7 for a combo meal, something like that. I mean, they're like $12, $13 now.
Here's the real the real test is you cannot eat at Taco Bell for less than $10 anymore.
I mean, the joke in my family is we got to start eating at Costco, because I don't know if you know this, but Costco has a soda and a quarter-pound hot dog for $1.50. It's been $1.50 for the past like 20 years or so. Google about it. Google the Costco hot dog.
Is it like the Arizona tea 99-cent thing?
Yeah, it's exactly like the Arizona tea. And I think there's a story that I guess goes with it where one of the CEOs was transitioning from Costco, and he's like told the incoming CEO, dude, if you touch the price of that hot dog, I'm coming for you. Like, it's just the weirdest thing. Like, you go there and you get this giant quarter-pound behemoth hot dog and a soda for $1.50. Yeah, there's inflation and there's all kinds of causes for it. And I don't personally believe there's one singular cause. I think there's a stack up of things, but that's not really kind of the point that I wanted to bring up. I bring it up because what happens when you get inflation that really gets rampant like that is the Federal Reserve, who controls interest rates and lending rates, their job in life is to give stability and pricing stabilization to the economy. Like that's their core charter. And in order to do that, they manipulate the lending rates of funds from, the federal government. And when inflation gets out of control, they raise interest rates. And what that does is it increases the cost to borrow money. And companies like to borrow money to use leverage so they can grow faster. And the reason this helps to control inflation is because if companies, it's more expensive to get the leverage, then they're less inclined to take the leverage. So they're not going to ramp up their growth plans. And so they start kind of scaling back a little bit. And when they're not growing crazy, they're not creating extra value, right? So that's driving prices up and all of that kind of fun stuff. And so that's kind of how they keep all this thing in checks and balance. Rates go up, companies borrow less, growth goes down, valuations come in because everybody, part of trading stocks is you're trading the future. You're not trading the now, you're not trading the past, you're trading what might be. And so all of these things have kind of come together in the first half of 2022 to really produce one of the worst market environments in a long time as far as equity performance. And that's really where we are. I mean, you've heard Viper and I talk about the pain that we're in and, oh my gosh, the declining and just keeping it real, saying, look, it's not all, cash pouring from the sky so we can buy Lambos and things like that. It's been a rough 2022 so far.
Yeah. Yeah. And I'll keep my position, I guess, or viewpoint fairly concise to say that obviously, like I mentioned on previous episodes, I, not by any stroke of genius, just happened to pull out of equities, not at the top, but, as things were getting squishy, and just kind of locked up that cash for a little while. And my basic view is like I'm genuinely starting to get excited about the other plan that I laid out in a previous episode, where I'm starting to DCA into things like VOO and VTI as mutual funds of the entire market or the entire S&P 500, because those are down so big. And as we've talked before, and as we're about to talk now, you don't call the bottom, you just call when it's time to start buying. So I'm genuinely at this point where I'm excited about dollar cost averaging back in, because, like you said, the news is doom and gloom all over the place. But that's how these cycles work, or so I'm told, because obviously this is, as we've talked on the show, this is our first major moment like this. I mean, even though the size of it is a lot of people's first major moment, but just a general pullback in the market, a bear market. We've been in this thing mostly in an entire bull. I'm starting to see and experience, because I'm in this, that disconnect between the doom and gloom, the fear, uncertainty, and doubt, and what's happening. And because of what we've been doing, because of what we try to share and build here, I have this sense of calm and confidence of like, no, this is fine. Everything's fine.
And not this is fine in the meme kind of way with a dumpster fire. Like quite literally, it's really okay.
Yeah. Yeah.
So, I mean, I can chime in a little bit here more about the positions that I'm really taking here. And where I'm at is a lot of my portfolio is, one, it's weighted pretty heavy in financials. I have a pretty large Citi holding. I have a fairly decent size holding of Apple, which I consider one of the more tech blue chips. I have a very large holding, I shouldn't say very large, a decent size holding of a ETF that does basically covered call strategies on tech growth stocks. So it moves very, very close to the NASDAQ. And so I have a lot of positions where I think they are stable things that have taken a lot of their licks, and I've kind of increased my position size, not quite to the dollar cost averaging that Viper is looking at. I was a little bit too early, but you can't time these things perfectly. And I'm feeling better about those because of what I'm seeing each day in the market. Yes, we're still kind of declining, but we've been kind of going up, and we get these tiny little pullbacks, and the buyers come in before you really kind of crash through the previous levels. And so we're kind of on a tiny little stair stepping up. And so I thought today, when the CPI numbers came out, I'll be honest, I knew they were going to be high. They were slightly higher than what I had anticipated. CPI stands for Consumer Price Index, and you can think of it like the cost of goods to live. I mean, it includes clothing, housing, food, energy, like all the things that the consumers buy are included in this CPI index, and it's maintained by the Bureau of Labor Statistics. And the way that they gather this data is they constantly do price checkers that go out and they monitor the price of the same types of items in thousands of locations spread out geographically all over the world. Most of it is in the United States, but they do try to track some of the stuff in foreign countries and things like that to just gauge a sense of where stuff is going up, where's it going down, and they always present that in usually a monthly time frame relative to 1 year prior's month. And so today's number, I believe, was 9.1% for June, meaning that everything cost 9.1% higher this June than last June. And that comes on the tail of a May CPI number of like 8.6% increase from the previous years of May. And a lot of people were saying, oh my gosh, inflation is the highest point it's been in 41 years because these CPI numbers haven't been seen since 1981, the early 1980s. And so, it's always good to know your history. It's always good to know what things happened when, why did they happen, and kind of do that look back. And so, today wasn't the first time I looked back at this because people have been drawing this analogy now for several months. But back in the late 1970s, the United States was under massive inflation pressure. I mean, just the inflation was out of control. It was skyrocketing upwards, very much like today. And the Federal Reserve came in. Paul Volcker, if you want to, Google a little bit about it, came in 1979, maybe. I'm not sure of the year, but basically around the turn of the decade there. And he just dropped massive rate increases from the Federal Reserve. And, tried to get this inflation under control. And, they didn't plan for it. I mean, it came in with like a hammer and just smash. And the corresponding, what did the markets do? Because that is a time or a place that's very similar to the same circumstances that we have now. And so Viper and I kind of took a look at that, and I'm going to cut over here to show you some of this time frame and see what happened, and then we'll kind of chat a little bit about some of the parallels there.
Yeah.
So Viper, I'm going to bring up the screen here.
Yeah. So what we're looking at here is we have three different charts up here. This chart up here is going to be just our S&P 500. Down here we actually have the CPI year over year numbers. We determine, because you can see 6.08 is the latest number, we've determined that this is minus food and energy, but generally the trend is still going to hold. It's just a little less, so 6.08 versus the 9.1.
Yeah, so they call that the core consumer price index, and the reason that they add core is a lot of times geopolitical things or weather, droughts, things like that can heavily influence energy prices and food prices and things like that. And so there's two different kind of CPI numbers that come out. There's the core CPI, which is the CPI number, but they take out food and energy because there's so much more volatility in those type of numbers. They're not the best bellwether for the overall trend of prices. Now, when it goes to consumers' pocketbooks, the CPI number is definitely more meaningful, and the Fed tracks both of these, and they take them both into account. So it's not like they only look at one, look at the other, but that's why our graph here is the core CPI number. We didn't find a similar one representative of the broader CPI with the same year over year.
And then up in the top right here, we have the dates of U.S. recessions as inferred by GDP-based recession indicators. So this is when this is high, this is a period of recession, and when it's low, it is not. So we kind of wanted to correlate previous events, like Sprocket was saying, history to current events. So Sprocket brought this up and specifically wanted to come back and kind of focus on, this time frame back here. So do you kind of want to go? I know you kind of mentioned a little bit the rate hikes and whatnot, but do you want to talk about what it was specifically about the early '80s that you wanted to focus on?
Yeah, what I really wanted to kind of focus on here is the situation was very similar to today. Inflation was out of control. The Fed came in with a hammer, raised the rates, and a recession followed. And the reason that's so similar to today is because inflation is super high. The Fed has been telegraphing, we're going to raise rates. We're going to raise rates. We're going to keep we're going to keep inflation under control. And the market is saying, oh my gosh, if you do that, you're going to cause a recession. And so that is why stocks have kind of been sliding and dropping, because in a recession, there's economic contraction. And that's why I think it's kind of relative, because people are talking about a recession, which has not arrived yet that we know of. If I can just talk briefly about the definition of a recession, a lot of people don't maybe know what defines a recession. And in general terms, a recession is defined once you get 2 consecutive quarters of GDP contraction. And GDP is like the gross domestic product. It's a measure of economic output of a nation. And whenever you get negative GDP, that would be contraction of the economy. And when you have that for 2 quarters in consecutive, they say, oh, so starting at that contraction point, whenever the first quarter was that you had contraction, that was the start of the recession. And so it's not like somebody wakes up today and says, oh, recession started today. Whenever a recession is defined, it basically already started once they know that definition arrived. Yeah. It's kind of similar to, a bear market is once a index falls 20% off of its high. Once it closes 20% off its most recent high, the bear market started on that decline.
Yeah.
And so I want to bring all that in, because one of my opinions is in the early 1980s, the same situation existed as today. The only difference is the Federal Reserve didn't really telegraph the monster rate hikes that were coming. They just kind of went, wha-bam, and then everything reacted from that. And that's where I wanted to call Viper's attention when I started looking at this today. And I said, oh my gosh, look at this. Inflation went up. They smacked it with the rate hammer, and we went right into a recession. And I think we can maybe go into some of that here, Viper, but the difference between then and now is now everybody sees this train wreck coming. And markets are typically always forward-looking when they think something's coming. In the early 1980s, I don't think they saw it coming. So when it happened, it was more reactive in the market pricing. But call it rosy thinking, but I feel a lot of this is priced in today.
Yeah. So there's three things that I think we should walk through to kind of build that case, or maybe not even call it a case, just build that speculation, that warm and fuzzy how we sleep at night. I don't know, whatever you want to call it. But if we look first in this area here, so this is going to be this is going to be that smash here. We see inflation take a nosedive. Those were the rate increases that kind of came out of nowhere. And if we highlight specifically what we're talking about, we're looking at this particular crash here. Now, remember, this is the early 80s, so it's hard. I guess I can zoom in on this a little bit to make it more dramatic. But I did put this percentage price move here, and the market dropped about 23% in this moment of battling inflation. And so since these charts are all synced up here, we can see we hit, where it's at right now. We're at the peak of inflation, and the hammer comes down, and the market, the S&P drops, that 25%. But you can also notice that the recession over there is kind of timed up with this drop in the market, which is different than what we see today, because today we don't have a marker of the recession yet, and obviously the markets are already way down. But this goes back to the theory that nobody saw this coming, and it was just announced of boom, here goes jacking up the interest rates, and the market had to scramble to react in real time to everybody learning about this at the same time. And then we can also see, if we look at the inflation rate down here, we did have a period of inflation in the mid 70s, which was actually a 400% spike in inflation. And then the moment we're talking about here was inflation was up 83%. But I mean, that was kind of all a continuous thing of the decade. So, this was 83%, but we're building on, it was a rebound of this 400%. So that's kind of the runaway train of out of control was up 400%. It started to come back down. Then we ran up another 83%. And so then we just kind of smashed it and tried to get rid of it. The second area I wanted to bring up was the late 80s into the 90s, which this isn't as correlated to today's, but the one thing I wanted to call out here was just market reaction and recession. Because I think this kind of also helps set the stage, because again, what we're analyzing here is how the market reacts before, after, during a recession, and some of the details about that recession. So here we have a 30% drop in the market. So this is a massive dip in the market. And if we look over on the recession chart, we can see we go through this whole dip, and we're actually working our way back up before a recession actually hits. We don't need to get into the details of this now, but if you look up, what is it? Black Monday, Black Tuesday, a black day, a bad day.
Yeah, Black Monday. Black Monday, 1987.
Yeah.
Is the largest one-day drop in stock market history.
Yeah, so building my own theory here, this was a very much a surprise event, and this was a very different thing. It wasn't related to inflation, because as we can see down on the inflation chart, all the way through this, inflation is not great, but also stable. It's not running out of control. We had an issue in the market, a liquidity issue. People had started a death spiral of selling, and so we hit this massive drop, which then, this thing, I mean, this also kind of plays into the idea of no one thing contributes. This whole system that we have, economic system, as not an economics professional by any means, it's a bunch of cogs and the wheels and gears and things in the system. And something like a 30% sell-off in the market is going to be a Molotov cocktail into the machine, and there's going to be ripple effects. And at least my theory is that's why this recession over here doesn't pop up until we are well beyond that dip in the market. But the call out here is there is a delay between massive market movement and officially entering a recession.
Yeah, and before I call attention to the rosy upside potential here, I want to kind of go back to where we might be, because we might be in a recession today. We might be. Like I said, a recession is 2 consecutive quarters of GDP contraction. Now, Q1 of 2022 was negative GDP, which means if Q2 comes in as negative GDP, we will have been in a recession since the beginning of 2022. And we won't know that until the end of August. So the Bureau of Economic Analysis, I think, is the one that tracks GDP growth by quarter. That in the end of August, I think August 25th, they will release the 2022 Q2 GDP numbers. And so should those be negative, we will have been in a recession from the beginning of 2022 January. Now, the point that I kind of want to make up or point out here is, yes, things are scary right now. Yes, the market has fallen over 20%. We are in a bear market. But if we go back to this 1980s graph and we just look, maybe Viper, you can pull up the percentage change from that recession low, like when we were in that 24% decline, to that peak of there in 1987 before we crashed again.
Mm-hmm.
What's that potential upside?
Yeah, that's let's see. So all the way up till that crash, there we got from the bottom all the way to the top, 209% increase, which is
Right.
is
Now, I'm not
substantial.
saying we're about ready to go to the moon, but what I'm trying to call out here is that things are always darkest before the dawn. We have over a 20% decline on the S&P year to date because people are pricing in the high probability of a recession. So could we go lower? Absolutely, we can go lower. I'm not saying we can't. But if we look back to a similar point in time with similar economic conditions, there is a probability that we could be nearing the bottom. And that's where this dollar cost averaging comes in. I think it was Mark Twain that said, history never repeats itself, but it often rhymes.
Yeah. So where we're at today is we have the pandemic crash back here. We come flying up, and right now we are sitting at about a 20% drop. And so we're looking at this right now. Now this looks familiar. Obviously the recession chart doesn't show anything yet because we have not declared anything yet. But this is kind of what we've been talking about. If we're down 20%, if I get this out of the way for a second, we've talked on a previous episode about where we think, potential retrace could be. And, we've also talked pretty strongly about, this is pure speculation, but somewhere around 3250 feels like a decent amount we could get down to, possibly. And the previous episode, we kind of dig into the chart a little bit more detailed. I'm just kind of going off of memory and what this line graph shows. But we had reasoning behind 3250. And I mean, currently we're testing this 3770 level, which appeared here. And there is one more stop here around 3500. But nonetheless, that checks out because, we don't think this 20% that we're in is necessarily the bottom, but it's significant enough to start taking those nibbles. And so if we look a little bit speculatively now, and this is pure, let's say this is the bottom of the moment, 31%. First of all, that checks out to previous drawbacks in the market, 20 to 35, 20 to 40%, somewhere in that range, seems to be how we react in major bear moments, in major recession moments, which would then, kind of put us in this area here, which would have us, hitting that bottom there. And as we've seen in virtually every pullback before, then kind of sends us on this, hit and run, recapture and potentially go up. This is absolutely not guaranteed or what will happen, but this is a game of probability, and the probability I think is strongest on somewhere around a 30 to 33% pullback before we then start gaining again and we start climbing back up. But it doesn't have to pull back this far. But nonetheless, this is in the realm of speculation where I think we're at, and kind of what we've laid out previously was we're already 20% into this pullback. Whether it ends here, whether it ends at 30%, whether we go all the way back to, let's see how much it would be to go all the way to the bottom of the pandemic crash. That would be a 45%. That would feels pretty excessive at that point, but does not mean it can't happen. So whatever it is, we're well into it, I think is the point we're trying to make. And there's ways to deal with that, and mentally and in your portfolio. And so this is kind of where we're at and what we're thinking in this moment, which both is an interesting study because never been here before, but also I think important to be setting that expectation mentality of not just doom and gloom. I'm going to lose all my money, because if you follow that train of thought, the doom and gloom, and you trade based on the sentiment in the market, the sentiment in the media, you probably will lose all your money, because that is all lagging. When the media is up on everything's good and rosy, you missed the bottom. You missed not just the bottom, you missed the trend up. So trying to keep our senses about all that is kind of where I think we're at.
Yep, absolutely. You got to take everything as a data point. And when the market is screaming, take all the risk on, that's probably the time you should be taking risk off. When the market's saying, or when the media is saying, oh my gosh, take the risk off, this is terrible, we're going to the bottom, that might be the time where it's time to start putting the risk back on. It's a contrarian trading attitude. It's the trading attitude I like to have, because a lot of that sentiment, a lot of that media is very, very lagging.
There's I don't know, it's not really a meme, but there's a joke going around in the crypto circles that crypto, the bottom is in, and the indicator was Jim Cramer, not picking on him. I think does very animated stuff, and has some good takes on stuff. But he recently tweeted, crap, now I forget exactly what it was, but basically he said, Bitcoin is a joke and has no real value. And everybody called that the bottom is in, because he's the exact guy who literally 2 months ago was making a big deal about buying his Bitcoin and buying his Ethereum. So stuff like that, the fact that hit that level of narrative, this thing is worthless, it's junk, it's crap. That's the kind of thing you're looking for as that bottom signal. But
so that brings us to the end of this episode, just kind of taking a look at Viper and my's opinion on where we are in the market today, where we think we're headed, why we think that. It's always good to understand your history, know other past events, learn from them, what's similar, what's different. Take as many different angles as you possibly can. Don't just take the one angle that backs the thesis that you like. Right now, I can tell you that I am very, very concerned that my perspective on the market is skewed too much into what I want to have happen. And so there's a couple of traders in the Discord that would probably tell you, yeah, man, you've been talking like you're not even that sure of yourself these days. What's going on? And it's because I'm trying to be cognizant of my own biases. Because my portfolio is weighted in a certain way, I am not delta neutral right now. That is something I always try to be, and I am not. So I'm trying to take a look at a lot of the data points objectively and not just ignoring the ones that doesn't support my thesis, but take those into account. And I'm learning right now because I want the market to go a particular way. I want my thesis to be right, and I'm trying not to only look at those data points, but those data points come out a lot at me. So maybe there is something to it. I don't know.
Yeah. I mean, and that generally summarizes the struggle of trading any market, anytime, during any market. Bear or bull is that constant emotional motivation, not just to do something, but to read something a particular way. And that, not to tangent too hard, but that has probably been one of the greater things that maybe we could get into it in a whole nother episode. But, as I continually reevaluate my time so far in crypto and stuff, and just how brutal that's been compared to the equities market, I'm definitely taking a lot of lessons on how to behave and how to react with as little emotion as possible. And the only way I'm learning that is by acknowledging when I was too emotional and when I did things based on emotions. And I'm at a point now where I'm kind of transitioning a lot of those lessons into what's happening in equities. And I'm definitely feeling internally, in a way that probably can't be described, how that's going to benefit me long term. And so money lost is tuition at this point.
Yep, absolutely. So hope you guys enjoyed this episode. If you didn't, let us know. If you did, let us know. Leave a comment, hop in the Discord, tell us what kind of content you want to hear from us. Love to make it. Otherwise, good luck out there. Earnings season right around the corner. We're really going to start to see some more additional, peek behind the curtain about what companies are getting impacted with and what their outlook is on the coming, couple quarters, balance of the year. So have fun out there. Good luck, and remember to think outside the block.